Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Rick Rule, the President and CEO of Rule Investment Media, LLC. Rick, how are you today?
Robert, doing very well. The better for being on with you. Thank you.
I really highly appreciate you taking time out of your day to record this. I don't always like starting with date stamping a podcast, but I will say for purposes, this is being recorded on the 23rd of October, released on the 24th of October. And the reason I date stamp that is because anything could get mentioned at this BRICS summit at the moment, and that could cause chaos in the market. But I thought it would be good to say that because I want to go back to the fundamentals. There's a lot of euphoria out there, and I couldn't think of a better person to have on to go through the fundamentals of commodities wise. Where are we? Where's it likely going? And why is that the case?
Thank you. Where would you like to start? That's a fairly broad topic.
It is. I realised that in a minute I said it. Okay, let's look at the current situation then. We've had silver recently touched just under 35, I think it was, pulled back down at the time of recording, but it's likely to go much higher. I think that's a sentiment you'd agree with, but why is it likely to continue going higher?
Well, silver is an interesting beast, and if I take myself out on that limb, I may cut the limb off behind myself. But let's try this. My experience in precious metals bull markets has been that the momentum is established by gold. The gold buyer early on a bull market is a fear buyer, not a greed buyer. The gold buyer is someone like me who isn't necessarily buying gold because he thinks technically it's going to be strong. He or she buys gold because they want to maintain their purchasing power. And the gold trade does better and better as the faith in fiat denominated savings instruments gets worse and worse. I think we're seeing that in the gold market. In my experience, the momentum has to be established by gold. And when that momentum trickles down, if that's the right phrase, to the generalist audience, the non-precious metals audience, leadership in the market changes to silver. I don't know why that is, to be honest with you. I just know, having lived through 4 precious metals markets and mini markets, that's what happens. At some point in time, when the narrative becomes accessible to generalist investors, market leadership changes from gold to silver. Silver moves second, but when it moves further and faster. Whether or not we are at that place yet is a very different discussion. The uptick that we've seen in the silver market, the physical silver market, is fairly recent. I will note that the silver equities, which generally follow silver, in this case preceded it. And I suspect that's because at least the second tier silver stocks were so roundly hated in November, December, January, that they had a dead cat bounce. In other words, they moved without silver simply because they'd been oversold. But again, I'm speculating. So it makes some sense that with the gold price moving by 30% this year, and by the way, moving at 8% compounded for the last 24 years, that silver would begin to catch a bid. Whether or not this is a breakout move in silver, I can't tell you. What I can tell you, having lived through 4 silver bull markets, is that you won't need me to tell you when silver breaks out. It's a fairly dramatic event. And silver doesn't mess around with weekly moves of 1% or 2%. When silver moves, it gives you, 100% or 200% price escalations. It's probably worthwhile for your audience, looking back in history at the dimensions of a silver bull market. And by the way, one more time, I'm not saying we are or we aren't in one. My first bull market was, of course, the decade of the 70s, when I was too young and too poor to participate in the first part of that market. The silver price went from somewhere under $1.50 to 50. A fairly dramatic move. The second market, though, the market in the early 1990s, late 80s, 1990s, uh, $4 to a number that approached 50. Similarly, the market that we enjoyed in the period 2000 to 2010, single digits to 50. It is not uncommon in a silver bull market for the silver price to increase fivefold. Am I saying it's going to increase fivefold from $35? No. What I'm saying is if we get into a silver bull market, a move from $35 to $50, which is something that would have the silver bulls excited, is nothing. It's absolutely nothing. And one more piece on this monologue. When people talk about the previous high of silver being $50, they're talking in nominal terms, not real terms. That $50 price was accomplished 15 years ago. And if you use even the CPI number as the measure of the debasement of the currency, the number would have to be substantially higher than $50 to have a real breakout against the currency. I think it's important to understand that.
I would totally agree. And do you think that there's a lot more emphasis, I think, nowadays on silver in terms of its various industrial uses that may not have been around years and years ago? Do you think that plays a part in potential movement or the general narrative regarding it?
Well, in fairness, there's been a replacement of other industrial uses. Silver used to be the key component in photography. A lot of it was recovered. So there was a very, very, very high recycle ratio. What's interesting now is that many of the industrial fabrications for silver don't have very many recycling applications. At present, at least, when you use silver when you use the reflective property in solar panels, the ability to recover silver from the solar panels at this silver price is fairly low. Similarly, when you use silver for a germicide or you use it for its properties in wastewater processing, the silver goes to silver heaven. It doesn't get recycled. So you could say that the net industrial uses are higher, not the gross industrial uses. And that's interesting. But my own experience has been that silver bull markets come about as the market begins to reabsorb silver as an industrial as a monetary metal, not as an industrial material. Periods of extraordinary weakness in the bullion price have very little to do with peaking cycles in industrial capacity. They have a lot more to do with user sentiment.
Fair enough. Okay, just thinking off the top of my head then, you mentioned that gold sets the way, and that's perfectly understandable. So why, and again, I'm asking very generic, basic questions here because it's easier for me to ask the very generic questions and, to get the best out of everyone I find. So why has the gold price soared up this year? What various factors have contributed towards that?
I think that gold has been a coiled spring. When people ask me in interviews like this, when is the gold price going to move? I say the year 2000. Gold was at $253 an ounce. It's over 2,700 now. It's increased 8% compounded for 24 years. It's done its job. More recently, I think two important things have happened. The US dollar has been weaponized by the US government. The US government has attempted to use the US dollar status as a reserve currency and the global medium of exchange to enforce US policy perspectives on other countries that don't necessarily want US policy imposed on them. Whatever you think of Russia's adventure in the Ukraine, the US government stealing $300 billion in Russian assets, US treasuries, sent a real message to foreign central banks about the trustworthiness of the US dollar. The second thing is more, and that of course has meant that central banks have been forced out of the US dollar. into another medium of exchange that isn't unconvertible currencies, like the renminbi or the ruble. um, in effect, the United States has forced other people to abrogate some part of the U.S. franchise around the U.S. dollar. The second thing that happened is a bit more subtle, but the U.S. Treasury is, at least from my own point of view, a bad deal. The debtor, in this case, the U.S. government, went from having, in the year 2000, on-balance sheet liabilities equal to 36% of GDP, has gone to having on-balance sheet liabilities at 120% of GDP. The aggregate debt, admittedly in nominal terms, now exceeds $35 trillion on its way to 36. Much more concerning and much less well reported is the off-balance sheet liabilities of the U.S. government. The net present value of off-balance sheet liabilities, things like Medicare, Medicaid, Social Security, federal pensions, military pensions, the Environmental Trust Fund, that number, by the reckoning of the Congressional Budget Office, exceeds $100 trillion. And the on-balance sheet liabilities are growing because of the deficit at about $2 trillion a year. Nobody knows the accretion of the unfunded portion of the net present value of off-balance sheet liabilities, but estimates are that that number increases by $2 or $4 trillion a year. So when people look at the U.S. Treasury, they are beginning to look at the fact that the Treasury debt can't be paid. The net present value of that obligation almost certainly gets inflated away in the same way that the U.S. government inflated away our obligations in the 1970s. Over the 1970s, the purchasing power of the U.S. dollar fell by 75%, which is to say that the obligations didn't go away, but the net present value of the obligations did go away. Or put more simply, if an old codger like me expects to get $2,500 a month from Social Security, he will. But that $2,500 will buy $400 or $500 worth of goods and services. That's what people need to understand. And I think that's reflected in the gold price. The U.S. at once weaponized the dollar and devalued the paper. The third thing to recognize, and again, I'm sorry for this long-winded response, but these are deep questions. I think that people around the world, but also in the United States, are starting to realize that the rate of inflation, as measured by the CPI, is false. The CPI, among other things, when it's inconvenient, doesn't include food or fuel, which is of very little use to people who eat, which is most people. The CPI doesn't also include tax. Now, it's a fair argument that taxes are neither good nor a service, but the fact is that they are a component in everyone's cost of living. My own definition of inflation is the deterioration of the purchasing power of my savings relative to the basket of goods and services that I consume. The government would have you believe that that deterioration is measured by the CPI and is about 2.6% a year. I would ask you and your listeners to do a thought exercise with regards to the basket of goods and services they consume. In the last 4 years, have your gasoline prices gone up? Have your grocery prices gone up? If you are a renter, has your rent gone up? If you're borrowing money for a mortgage, has the mortgage interest rates gone up? And in particular, have your direct and indirect taxes, which aren't measured by the CPI, gone up? When I conduct that same thought exercise, and I'm an old rich guy. I don't buy much. I've already done that. I find that the purchasing power of my savings in US dollars is deteriorating by about 7.5% a year. And now let's look at the conundrum for savers around that. The world's premier savings instrument, despite the best efforts of the US government to wreck it, is the US 10-year Treasury. That instrument yields what, 4.25 today? In a currency where I believe the purchasing power is declining by 7.5%. So if I lend my money to the US government, they will pay me back, even if they have to print it or steal it from a taxpayer. They will pay me back. They will pay me back at 4.2% in a currency where my purchasing power is declining by 7.5. In other words, the US government solemnly swears that they will reduce my purchasing power by 3 or 3.2% compounded a year for 10 years. The first government promise in my lifetime that I believe, but it's not a very good trade. And I think you're beginning to see disintermediation out of a guaranteed loss into a medium of exchange, gold, which has for over 1,000 years maintained its purchasing power in times like these and conditions like these. And I'm very sorry for that long-winded answer, but I think younger people need a fuller explanation than they've been given, and one grounded in history.
I agree. And don't worry about the expansive monologues, because I do find that that's useful, just sitting back, asking what I would consider layman's questions to then get full on answers, which is what we're here for. We're here to add value and educate people. And I do think, I think this is a quote, because I've heard you say this numerous times on various podcasts and YouTube channels, etc., that you often say that you are, one of the reasons that you own gold is you're almost afraid that it goes up to $9,000, for example. Can you just clarify what you mean by that and why, please?
Sure. Speculators own gold because they think it might go through 3,000 or some number like that. I speculate in other asset classes. Gold is insurance for me. So, Robert, think about yourself in insurance. Life insurance, to get paid somebody died. Auto insurance, you got to get in a wreck. House insurance, your house burns down. Every set of circumstances where you get paid owning insurance is bad. I don't want to get paid on my social catastrophe insurance, which is what gold is. The set of circumstances that would cause gold to go to $9,000 or $10,000 are invariably unpleasant, and I have a very pleasant life. But when I look at the circumstance where my government guarantees me a loss of purchasing power if I save, and I'm a saver, I believe I have to insure myself against them. If we saw $9,000 gold or $10,000 gold, the impact of the circumstances that caused that price quote would almost invariably be lousy. My suspicion is that the real purchasing power of gold wouldn't be up that much, but the real purchasing power of the dollar would be down a lot. And people who hadn't been prudent enough to prepare as well as I have would doubtless be experiencing real pain and would be evidencing both envy and anger. And, you know, those numbers are not outlandish. When you look at gold at 2,700 and you talk about the possibility of it going to 9,000, forget the bull market of the 1970s, because at the beginning of that period, it was price controlled. So it went from $35 to $750. Let's assume that it should have started the decade at 100. Going from 100 to 750 isn't that outlandish when you consider the fact that the purchasing power of the US dollar declined against other goods and services by 75%. Or more reasonably, look at the bull market in gold in the period 2000 to 2011, where it went from $253 an ounce to $1,700. What's that, a sevenfold increase? The suggestion that in the face of on and off balance sheet liabilities of $135 trillion and the need to inflate away the net present value of those liabilities, the idea that the dollar wouldn't again in the next 10 years lose 75% of its purchasing power is, I don't think, aggressive. And if that happens, a tripling of the gold price, as an example, as opposed to a sevenfold move, which is what happened in the decade 2000 to 2010, I don't think is outlandish at all.
In terms of, well, I say just the US, we'll just focus on the US because that's what we've been speaking about. Do you reckon that with GDP ratios in the UK, I think we're about 110% at the moment over here. Do you think we're just on this slippery slope and there's no way back and that's it and we're just going to keep avalanching towards whatever the end game is? Or do you reckon there is a way to turn back, but no one wants to do it because it's going to be difficult and painful for most people?
I think the way back is podcasts like this. I don't think that the answer is going to be found in the Financial Times or the Times of London. Currently, government spending programs are extremely popular with the populace. Everybody believes that the benefits that they get from the government are right and proper. And everybody believes that the benefits other people get from the Commonwealth are fraud and a waste. There's a wonderful quip, I think it was Gore Vidal, hardly a libertarian, who said that you understand politics by looking at the root word, poly, from the Greek for many, and tick from the English colloquial for small blood-sucking insect. If you think about the political process in that manner, then you understand the difficulty proposed by austerity regimes. It's worthy to note in the United States, Ronald Reagan did not reduce the size of government. He reduced the rate of its growth. Margaret Thatcher never reduced government expenditures in Great Britain. She deregulated and she reduced the rate of government growth. My suspicion is that given the fact that debt to GDP ratios in both Great Britain and the United States are so much higher now than they were when those politicians were in place, that merely restricting the rate of growth probably won't be sufficient to get ourselves out of the morass. What will get us out of the morass as a people is reducing the benefits via fraud, which is to say inflation. The nominal level of benefit measured in pounds sterling or dollars stays the same, but those pounds sterling or dollars buy much, 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 much less. We did that in the decade of the 70s. The answer at the end of the decade of the 70s from the population is that they didn't want more pain, and they came to understand that some form of austerity was needed. At the end of the decade of the 1970s in the United States in 1980, we elected Ronald Reagan. Again, he didn't reduce the size of government. He just reduced the rate of its growth. And you all elected Margaret Thatcher. Again, she didn't reduce the size of government, but there was an awareness in the American and the British body politic after the aggregate levels of expenditure had resulted in the deterioration of the purchasing powers of the currencies by more than 75%, that some austerity was needed.
And of course, if we're then going down the route of inflating our way out of it, I think you alluded to earlier on, I know people like yourself, myself, and a lot of other people are going to be acutely aware of that. Let's assume that the masses are not aware of that. I mean, it's the ultimate stealth tax, isn't it? Inflation, and people just aren't alert to it. I don't think that's what I get from the general population.
That's what I get too, and that's why at age 71, I spend all my time on podcasts like this talking to younger people. If your audience, and I suspect it is below 50, what you need to understand is that in both your country and mine, my generation voted ourselves all kinds of cool benefits. Really great stuff, We forgot to pay for them. So we spent all the dough, and you guys get the bill. And you need to decide how you feel about that. And you need to decide what, if any, obligation you have to your children and grandchildren. It's your decision, not mine. I know what the answer is. The next 10 years, we'll certainly see, I think, the pound and the dollar in terms of purchasing power be devalued by 75%. What happens beyond that is really society's call. I personally continue to be an optimist, particularly in the United States because I'm more familiar with it. Despite all our sins, we're still a culture where 4, 5, 6 young people commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple, something that changes the world. And oh, by the way, makes $3 billion a quarter. So in the long term, I'm extremely optimistic. I'm optimistic about my own future. I'm less optimistic about the next 10 years and about the people who haven't prepared themselves for what lies ahead. I think there's going to be, not in a biblical sense, in a real sense, a reckoning. And I think that people need to get their houses in order very, very quickly. A lot has been made in the popular press about the fact that there's $140 trillion in private inheritable wealth in the U.S., that there's tremendous wealth impact coming. I saw that quoted in Forbes not too long ago. So let's assume that number is correct, $140 trillion. And then let's look at the on-balance sheet and off-balance sheet liabilities of the U.S. government. Don't even look at private debt or local debt or corporate debt or state debt. That number is $135 trillion, which is to say the private inheritable wealth has already been spent by the Commonwealth. It's important for people of your generation to consider those very large numbers, however unpleasant that might be. In your country and mine, the mantra is repeated by the popular press, by the FTs of the world, that the debt doesn't matter so much because we owe it to ourselves. Wrong. The spenders owe it to the savers. We don't owe it to ourselves. We owe it to each other, which is a very different circumstance. If we owe it to ourselves, that means overtly we're going to confiscate the wealth of those who saved on behalf of those who didn't. If you can't count on society to save for you, and you save for yourself, and society's dead reckoning is that in addition to stealing your current account, they're going to steal your savings, then you're left understanding what the next decade feels like.
Yeah, that's sobering. That's a sobering thought. It really is. And I think that that's also why, doing this channel, speaking to people like yourself and getting all this information out there, is it just adds to the narrative that I always like to be about solutions. So what are the solutions? What can we do? Not let's all sit around and complain and moan. What are the solutions? And that is why I always say, and this isn't financial advice on my behalf, this is why people should look at things such as metals because of a multitude of reasons, and it's quite easy to access, and you can start looking after yourself. That's why they always say on an airplane, deal with your own oxygen mask before dealing with someone else's. Get your own house in order first.
I think that, first of all, you have to invest in yourself. There has been a belief for 40 years that working meant showing up and getting paid. We've globalized now, and there's a whole bunch of people that will work for less than us, and they will do more than show up. They'll add value, and we have to compete with them. You need to understand that getting paid involves generating more utility for others than you keep for yourself. People need to understand that. They need to develop contestable skills, and they need to develop contestable attitudes. They need to focus on generating value. The second thing is that people need to save. Even understanding that maintaining liquidity in fiat instruments, which you have to do for part of your savings, involves losing purchasing power. the difference between the interest you get paid, let's say 4.2 in the US 10-year and 7.5, that loss in purchasing power in the near term, I think, is an option premium on having enough money that you can take advantage of periodic liquidity squeezes like 2008 rather than being taken advantage of. I think, too, after you've saved, you have to invest. Traditionally, investing in precious metals, particularly gold, has for 1,000 years provided an inflation hedge. Will it this time? I don't know, but that's a pretty good track record. If you are willing to do the work, I think that you can invest rather than save in the big gold stocks. You have to do some work. You have to take some risk. Gold, you don't take much risk. It either works or it doesn't, but it's insurance, right? I think in addition to that, that you need to participate in the equities markets. Warren Buffett showed through the 1968 to 1982 bear market, a bear market long enough ago that most people don't realize it, but a 14-year equities bear market, punctuated by real inflation. Buffett showed that by careful stock selection, not by following fads, but careful stock selection, that he could generate a 20% compound return on capital employed during a 14-year time frame when the market in nominal terms went sideways and in real terms went down. And I think your audience needs to familiarize themselves with their own need to learn at least the rudimentaries of securities analysis, because the only way I think that they're going to stay ahead through the next 10 years is by judicious savings and investing. I don't think that the Commonwealth, and I use the Commonwealth to describe the body politic in any country, I don't think that the Commonwealth is going to be your savior the way the Commonwealth has been your savior for the last 60 or 70 years. I think it's running out of rope.
And it's not a very long rope, to be fair. Going on to public participation, I just want to wrap up one more question, generic questions. I know that people are going to say to me, Rob, please ask Rick about mining and dig into that, pardon the pun. So I'll get on to that. Do you think that there seems to be a complete lack of public participation, just going to gold and silver generically at the moment? Do you think there seems to be a lack of public participation in it? And if so, why? Is it mainstream media trying to cover up what's going on, or something else at play here?
The fact that I think it doesn't matter. Let me give you some math. In the US market, the market share of precious metals and precious metals related securities, both debt and equity, occupies about 0.5% of the total market for savings and investment products in the United States. That is to say, insignificant. Insignificant against a 4-decade mean of 2%. Gold doesn't need to defeat the US Treasury. You don't need a collapse in the US dollar. All you need is a reversion to mean in sentiment, and demand for precious metals assets and precious metals securities grows fourfold. And that's precisely what I think is going to happen. Now, why has this happened? I would suggest that the period 1982, after the back of inflation was broken in the United States, to 2022 was probably the most benign economic climate in the history of humankind. US dollar hegemony, declining nominal and real interest rates, globalization, superb demographics, the baby boomers in their prime earnings and savings years, the inclusion of women in the workforce, which, whether or not you support it politically or socially, was a real boom to the economy. And I suggest that all of that changed in 2002. I think the bad habits that happened over 40 years, the hubris in investment markets, and in particular, the increasing use of leverage, public and private, meant that I think we reached a tipping point in 2022. That what was incipient inflation has become stubborn inflation. What were artificially low interest rates ran into that inflation. And I think you'll see the real interest rate begin to increase as opposed to decrease. But the habits that we act on today are habits that were formed in 40 good years. It takes a while for the bad years to replace the memories of the good years. Past is prologue. The circumstance that we're going through today was evident in my youth in 1968. And even as a high school student, I wasn't too young not to see it, but I was unable to deal with it. It took the broad population really from 1968 to 1972 to understand the impact that inflation was having on their lifestyles. In other words, it took 5 years for the facts, for the arithmetic to change the paradigm, to change the narrative. And I think it's just happening today. If you look at the increase in the gold price that we're talking about and that has the gold bug so excited, it's happened really without retail participation. What we've seen really is concerted demand by foreign central banks, largely, I think, in response to the weaponization of the US dollar. Until 20 weeks ago, as measured by net inflows to retail ETFs, retail was absent from the gold market. And retail participation in the gold market is still tepid. I suspect that a year from now or 2 years from now, maybe longer, maybe shorter, that you'll see both foreign central bank buying and retail buying. And I suspect, if I'm right, that you could see a move in the gold price that will make the moves that we've seen so far seem fairly shallow. I watched that happen in the period 2000 to 2010, 2011. I think the other dichotomy that needs addressing here, Robert, is the delta between the move in the gold price and the move in the gold shares. And I think that you can explain that two ways. The gold price was driven by central banks, and they don't buy gold shares. So if one market was moved by a buyer that was absent from the other market, it makes absolute sense that there would be a dichotomy in terms of price action. The second thing is that the gold shares performed so badly as companies in the period 2010 to 2010 that the investment community is leery about expressing their preference around gold in gold shares. I think that that problem is going to be addressed as rapidly as this quarter. The margins of the gold producers have not done much in the last 2 years in the face of increasing gold prices, because the inputs involved in increasing gold, in producing gold, have increased too, which means that the margin expansion has been less dramatic than we had hoped. What we're seeing now on the cost side for things like energy and labor is that the costs are moderating while the gold price goes higher. And I think that you're going to see some absolute blowout quarters in the gold stocks. The quarter reported by Lundin Gold 3 weeks ago, I think, is exemplary. It didn't beat estimates, it obliterated estimates. And I think that you're going to see similar results out of places like Agnico Eagle. And that as a consequence of that, and a consequence of increased retail participation in the gold market, that you're going to see the delta between the bullion and the gold shares begin to reduce.
In terms of stocks, and again, I'm not necessarily going to ask you to name specific companies. Feel free to do so if you want. If people are listening to this going, well, I've got my physical allocation of gold, that's great, but I've learnt my history, and there could be some 2, 3, 4, 10x, companies out there. What sort of things do I need to look out for? Do I need to look at management, a location? Any generic pointers or advice would be superb.
I think for most investors who don't want to do a lot of work and don't want to take a lot of risk, that they buy the biggest and the best names. In my experience, beta, which I define as the outperformance of a sector like gold relative to the broad market, in gold bull markets is extraordinary. It's possible to get doubles and triples over 3 or 4 years on the best names in the sector with much less operating risk. So names like Franco-Nevada, Wheaton Precious, Agnico Eagle, coming down a tier or two, Barrick, Newmont, coming down another tier or two, Endeavor Mining, if you can take West African political risk, uh, or Goldfields, uh, you find that you don't need to come down into the small caps and chase alpha because the beta that you generate, if a move in gold of the order of magnitude that I'm discussing takes place, you'll do fine. You'll do absolutely fine without having to do a lot of work and without having to take a lot of risk. If you're looking for 10 baggers and 15 baggers, that's very different. You have to take risk, you have to stomach volatility, and you have to do a lot of work. You may know that I rank people's natural resource portfolio on my website for free, and I've ranked tens of thousands of them. And what I find, one of the most common investing mistakes, is that people own many more stocks than they can rationally follow. I ask people who speculate to have the number of stocks in their portfolio correspond to the number of hours per month that they're willing to spend reading 10Ks, 10Qs, proxies, insider filing statements. What we find is a lot of people who are willing to work 3 or 4 hours a month and own 60 stocks. And that doesn't work. It just doesn't work. It's a proven recipe for failure. So I think that people need to begin, as you suggested, by owning the bullion first, owning the insurance. Remembering in the period 2000 to 2010, that did fine against the depreciation of the dollar. Then, if you want to magnify that a bit as an investor rather than for insurance, own the best of the best. Own the Francos, own the Wheatons, own the Agnicos. Then, if you're willing to do the work and you want to generate alpha, absolutely, positively, go to the rest. But not until you've filled up your portfolio with better names.
Would the same rules apply for silver miners, or is that a completely different animal we're dealing with?
Very difficult to invest in the silver space. The investable companies all have warts. The best of them is probably Wheaton Precious, although Wheaton generates 60% of its revenues from gold. It still trades like a silver stock because it started off as a silver streamer. When you come down to the investment quality stocks, you confront real political risk. There are 3 jurisdictions that are competitive in silver. One is Russia, where the risks are fairly obvious. The other 2 are Peru and Mexico. And to invest in a silver company, which would be in the lowest quartile worldwide in terms of costs and the best quartile worldwide in terms of return on capital employed, you need to be willing to take the social and political risk of investing in Mexico and Peru. I do that because I have a very, very, very long time horizon. And I've suffered through this kind of stuff before. But I would suggest that silver itself, as bullion, is probably volatile and speculative enough for most people. And I would suggest, too, that for people who are willing to do the work, the most volatile asset class of all is the high-quality junior silver equities. A little bit goes a long way. But my friend Doug Casey has pointed out that the combined market capitalization of the high quality silver juniors, there's probably only 10 names in the space, is so small that when the generalist money comes down into the space, that silo literally can't contain the money. And the upside moves in those stocks is astonishing. I remember the decade of the 70s. Sadly, I was too poor and too stupid to participate. But Coeur d'Alene mines went from 10 cents to $65. That's not a typo.
Wow.
More recently, in the early part of the decade of the 90s, which was a nice little silver market. People don't remember it, but it was a good market. If I recall correctly, we underwrote Pan American Silver at the beginning of that at 50 cents. And 6 years later, it was over $40. We also underwrote Silver Standard at 72 cents. And similarly, it went to $45. The magnitude of the moves that happens with the high quality silver juniors, not the guys who just have silver as a component of the name and the share certificate, but the guys who actually have some silver. Those moves can be very dramatic. And I say that because they're high risk and they're highly volatile. A little bit goes a long way. About 2.5% of my equities portfolio is in silver names. And it wouldn't surprise me to see that 2% end up being 10 or 15 or 20% of my portfolio without any additions, if this market performs the way past markets have. People need to decide an amount of money for their portfolio that corresponds with the amount of work they want to do and the amount of risk they want to take, because that 2%, 2.5% could also be 1% of my portfolio. And there's a lot of folks as speculators who like the idea of a tenfold upside, but they can't stand the thought of a 35% loss. Without being willing to tolerate the one, you don't get the other.
Very true and very prudent. And I appreciate you touching base on that. Rick, you did mention the website where you rank people's stocks earlier on. Can you just share a little bit more about that, and then we'll look to wrap up?
Sure. And I say it's not I, it's we, our team, maintains a database of about 800 resource stocks worldwide. Any investor who likes what I have to say about natural resource investing is welcome to go to my website, ruleinvestmentmedia.com. List your natural resource stocks there, and for no charge and for no obligation, I'll rank them 1 to 10, 1 being best, 10 being worst. Note that my rankings are very harsh, much harsher than any commentator that I know. Note, too, that I'm not a broker, so there's no built-in bias for me getting a commission. Note, finally, that I'm back off a 3-week vacation, so give me 10 days to get your rankings back to you. I'm way, way, way behind. I'm about 400 rankings behind. Once again, Rule Investment Media, list your natural resource stocks. Please, no crypto. Please, no tech stocks. Please, no pot stocks. They're not what I do. But if you're interested in the way I think about natural resources, absolutely, positively, go to ruleinvestmentmedia.com, list your stocks, no charge, no obligation.
Perfect. I will put that, for those watching on YouTube, I will put that in the description. If you are looking at this from Substack, that link will be in the Substack article along with the audio and this video. Rick, I don't know what else to say apart from thank you for taking the time out to really deep dive into that. Would you, or do you have any other words of wisdom, any more positivity to give people, something else for them to think about before we say goodbye?
For young people in particular, 4 book recommendations. Start with The Intelligent Investor by Ben Graham. Some people may know him for his most illustrious student, who was Warren Buffett, clearly a pretty good professor. The best investment book ever written relative to the effort required to read it, which is low. You don't need to buy it. You can borrow it from the library, but you do need to read it. Don't put it alongside the bed and pet it. Read it. The second book is Securities Analysis, simply the best investment book ever written, but not easy to read. If you read Securities Analysis and you employ the lessons, you will become rich. Simple declarative statement. If you read it and employ the lessons, you will become rich as an investor. It'll take 20 years or 30 years, but you will become rich. The third book, and perhaps you should read this first, is Economics in One Lesson by Hazlitt, where you learn the way the economy works, not the way that the Financial Times would have you believe that the economy works. A wonderful book, easy to read, short, concise, an antidote to first-year university economics. The final book is very difficult, but it's the best book, the most impactful book I've ever read in my life. That's Human Action by Ludwig von Mises, teaching you how people respond to incentives, how they think, what groupthink feels like. It was written in turgid German and translated into more turgid English, so it's a very hard read. But it was, for me, easily the most impactful book of my life.
Perfect. Well, thank you for that. I will, as you probably see on the video, I was making notes. I'm going to, the first one I definitely read, Benjamin Graham. The other three I haven't, so I will add that to my list to get and purchase for myself as well. Rick, absolutely superb. Thank you. It would be delightful to touch base again, maybe in 2025, just to see where we're at. If you're up for that, that would be superb.
I look forward to it. Are you London based?
I am at the moment, but I am moving to Mexico in January 2025. So I will be that side of the world permanently from next year.
Well, I'll be in London for any of your London-based listeners. I forget the dates, but it's in early December at the Northern Miner Conference, investment conference in London. People who would like complimentary admission to that conference can go to Rule Investment Media and in the question and comment section in the rankings database. To the extent that the Northern Miner will allow me to pass out complimentary tickets, I'm happy to do that.
I might take you up on that myself as well, because I will still be here in the country. Rick, superb. Thank you very much. I'll put all of that into the show notes. Have a fantastic day and look forward to touching base again soon.
Pleasure. Enjoy Mexico.